Happy. Aye. Are moving averages really that bad? We're going to find out. Hi, welcome to the channel. If you haven't been here before, my name is Langers and I am the Scruffy Trader. And what I'm trying to do is put trading in the real world. Maybe show you a trick or two along the way. If that sounds good, please click the little subscribe button and the bell icon. Genuinely motivates me to do more and also notifies you if I do another video. So why am I looking at moving averages? Because everybody thinks they're terrible. They are, if they're used in the wrong conditions. And that's what we're going to have a little look at today. You see, moving averages are the basic of basic technical indicators. And they are exactly what they say they are. They just plot so many candles back and take an average. There are differences, of course. You've got the exponential, which adds a little bit weight to the end. And talking of weight at the end, how long have I waited for this?
Not long.
That was well timed, wasn't it? What do you mean, not long?
I've just come in.
You've just come in?
Yeah.
Right. She buggered off out, left me alone. I went into the kitchen, made a mess, and now love of my life has come to tidy it up. Actually, while she's here, we'll ask the ultimate question.
What's that?
Well, what question am I obviously going to ask?
No, I don't have a gold bikini.
I wasn't going to ask anything about what gold cane.
That's a question you always ask.
Was it? Well, it just goes to show what's in your mind, you dirty little tyke.
Well, hello. Ding dong.
Chances of a bacon sandwich.
Yeah, I'll make you big.
Get me lunch as well. It's a good day. It's a good day. See that? I took the law of averages there. Got my coffee. Asked her a simple question, which she thought was going to be a gold bikini, because most of the time that's what I ask. But I didn't. I blindsided her with a bacon sandwich. And I know that doesn't sound very sensical, but it's exactly what moving averages do. You see, you think because the moving average is showing you something, that's what the market is going to do. It's not necessarily so. How many times have you used a moving average cross? Crossed, think yes, it's time to go short or long, whichever. And the market inevitably goes the opposite direction. I bet it's happened 1,000 times. Happens all the time. Reason? You're looking at them in the wrong conditions. So what I'm going to do is I'm going to jump on the screen and we're going to go through it. And this all comes from some of the conversations I've had at the weekend and over the last week. And it's all based on this small account thing that I'm doing this month. Because people are genuinely curious as to how the strike rates are good and why it's building up the way it is. Well, it's very simple. And I'll go through that as well, because I'm going to give regular updates right the way up to the end of the month, just to show that it is possible. Now, the first reason it's successful is I'm patient. And the other reason is I'm disciplined. So I follow a set criteria. And moving averages are part of that criteria, but not the way that you think. See, most people go straight into small time frames. They think that's the way forward. It is not. Small time frames should be entry only. No trading decision should ever be made on a small time frame. And I know it's easy for me to say that, but it is true. You know, even if you are looking at 15 minutes, which is my preferred entry chart, I still can't make a decision on it. It's why I don't like scalping. I don't like scalping because the variables are in the favour of the market and not in my favour. I like it the other way around. And I do that from higher time frames. I analyse on a high time frame and I work my way down till I find an entry and then I trade it. As in the case of this little bad boy that's behind me. I only trade once or twice on a Monday. I don't like trading on a Monday. In fact, that was a question asked by Dave, and I do thank you, Dave. Thank you for the support. In answer to your question of why I don't like trading on a Monday and a Friday is exactly what I've just been talking about. The variables of the market. You see, on a Monday, I haven't got any recent data to analyse and make an informed choice, because as a day trader, I'm trying to figure out what's going to happen in the next hour. Whereas if I'm a swing trader, I'm looking at what's going to happen in the next week. Two different sets of criteria. So for day trading on a Monday, it is almost a coin toss, because on the morning, all the money flows coming in. I don't know whether they're getting out because they were caught at the weekend, or whether it's money coming in for a new position that's going to run for a few days. So what I do is I wait, I don't trade the opens anyway, let the money flow come in, then I can get a gauge of what's going on, and if I see a setup I might take one. But on Tuesday I can look at Monday, analyse all the data, find out which is the dominant directions, etc., and it puts the variables in my favour. And then subsequently on a Friday, it's another wild card day, because I don't know on a Friday afternoon if traders are going to be holding positions across the weekend because they're planning it on a swing, whether they are pulling out because they want to close off for the weekend, or any other variable like the non-farm payroll. It's a hard day to work on. So I'm normally out of the market by lunchtime on a Friday, and it's because the afternoons are so unpredictable, and also I don't want to carry my trades across a weekend if I can help it. So that's kind of why I do it. But I also make enough Tuesday, Wednesday, Thursday that I don't really need to trade on a Monday and a Friday. And like I've told you guys many times before, if you don't need to do it, don't do it. Because as long as I'm in that market, I'm at risk. And if I'm at risk, it can take it off me. So let me jump onto the screens, and I'm going to try and show you some ways to use a moving average, or what to look for with a moving average. And hopefully you can add it into your little toolbox. So come with me. Okay guys, so what we're going to do, we're going to pull up a clean chart as we are in front of us, and we're going to have a little look at how well we're doing with this small account challenge. I shouldn't call it a challenge, because it's not. It's just to inspire you that it can be done, and that is the basis of the entire channel. So I'll do that first. I'll just quickly pull this sheet up so you can see. Haven't done a lot today, as I was saying. I don't really trade much on a Monday and a Friday. I've taken a couple of trades, which is really one trade. This one came back, the conditions hadn't changed. So I entered the market and the bloody thing stopped me out. But I still got out at a profit, which means that this balance is growing quite well. You know, my gross is 318.79. And the reason why you see two different figures is because I've been banking money into a physical bank account, something that I employ you to do. And it just means you can have a little bit of a treat. So my goal this month was to earn a pie every day. That £40 has given me a pie. And it kind of echoes an email I had off Kevin. And I do thank you, my friend, who said that he drew some money out of his trade and bought a chocolate treat box or whatever it was. And then suddenly his trading became worthwhile because he got something from it. And whatever happens after that point doesn't matter because you earned your treat. And that's the way I look at this. You know, if you can give yourself a treat as you are going, it makes your trading worthwhile. And that's why I take the money out and put it in a physical bank account, because it means I can't use it anymore. It means I can't lose it. And this balance here means nothing. It is a tool for me to do my job, just like a hammer and a chisel. Okay, this is what's important. That's when it becomes real. And that's why my desk is littered with things that keep me motivated. You know, I get my toys and they're around here and they keep me amused. And I'll buy things like the artwork you see on the wall, and it comes from trading. I do the YouTube channel because you guys encourage me and you support me. Some of you join the Scruffy Squad because you want to learn more, but it encourages me to do more. And I do extra things for you. I'm still thankful of Gerald who sent me this. It is still on my desk, as is a similar one in my other desk where Chris sent me. I'm so grateful. And because these are being done, it motivates me to do more. And that's the key element, motivation. You have to keep your spirits up, guys. Like I say, you get an email about people and their confidence getting dented. Trading will knock the stuffing out of you. It really will. Because the general attitude is a one of, it's just button pressing. So there has to be a magic pill. It's not. You have to be able to read the chart, read the conditions, and understand what it is you're looking at. I can't tell you, you get in here and you get out there and it'll happen every time. It won't. What you need is screen time and be able to read the chart. My screen time's over 15 years, you know, and I'm getting guys emailing me expecting them to do it in 15 minutes. You're delusional. You really are. You've got to put the work in, you know. I had a bit of a kick-off at the weekend because some clown sent me a very nasty email because they come into the Facebook group and I hadn't direct messaged them with mentorship. What planet are you living on? You know, you come into the group, you ask no questions, you don't answer any of the posts that's on, but you expected the entire group to feed you. Doesn't work that way, okay? You must put the work in and the screen time. And the guys in the Facebook group might comment on this because I showed them what was sent from the dickhead who has now left the group because apparently me having a day off is unacceptable. Unbelievable. Anyway, sorry, I nearly got on a rant there and I was going to do a mega rant on that dickhead, but I don't really want to. I don't want to fuel the fire for them to think that they got under my skin. They annoyed the hell out of me because he insulted Winky. And trust me, I'd love him to say it to my face, you know, because I don't think there'll be very much of a conversation. But that's the way these people are. They hide behind a keyboard, think they're faceless, and they also think they're clever. But I'm still here, I'm still trading, and I'm still doing incredibly well. So that is my reward. Sorry, nearly got off on one. Oh dear. It's great being old. It really is. Sorry, right. Get back to this. Oh dear. Anyway, where are we at? Right. I am working to this plan. It's something I've shown you guys in the past. Starting with 50p. Pretty much got there on the first week. Certainly ahead of the game on week 2, and I'm now working to week 3. Okay, and that's the whole process. So little interlude is to let you know that we are still running. But why we're running? And it's because I use tools in the right way. And this brings us to moving averages. So if I put a couple of moving averages on this, so X that and say a 50. And the idea of a moving average cross is you have a fast one crossing a slow one. And if you haven't come across moving averages before, they are just a plot of price and an average. In other words, that's a red line is a 20. It will count 20 candles back average the price and just plot it, and it makes this line. And the faster the moving average, so if you had it as a 5, the moving average will hug into the price because it's only going back a small way. If you widen it up to a 200, it'll take time for the price to catch up. Simple stuff. And there's 3 major moving averages, and I'll show you the difference on them just now before we go forward. You have an exponential, and all it does is it gives a little bit of weight to the last 10-15% of the average, and it makes it react that little bit quicker. You then have a standard moving average, which is exactly what it says it is. It is literally just the last 20 divided, and then it plots its price. But it's not that far away from the other one. And then you have a VWAP, volume weighted moving average, which is here. So all 3 are 20, and as you can see, they're not a million miles away. So just find one that you like and stick with it. Doesn't make any odds. I mean, I've watched plenty of videos where they say they found the perfect moving average and it'll win every time. It's 17.5. It's bollocks. Look, there they are there, pretty close together. In fact, there was a study done once. I can't remember where I read it, and I think it came out 47 was the best moving average ever. Well, let's have a look at something. I'll just take the EMA off and the VWAP off, and we'll just use a standard. We'll put the 50 on, change that to 47. They're nigh on top of each other. In the grand scheme of things, it's not going to do a damn thing. You know, so 20, 50, whatever. I often use Fibonacci numbers just because I like Fibonacci and it fits in my mind, you know. But there's nothing wrong with a 20. So that's what we're going to do. We're going to look at a 20 moving average, because for a day trader, it's one of your best friends. All right. So here we go. At the moment, it's telling you not a lot, you know, because the price is pretty close to it. And if you were using it as a moving average cross, like say you would have your 50, what happens? Well, there's your cross. You're pretty late to the party, even though that's got some good meat on the bone. But when it crossed here, you haven't got a lot to go to. And these are on 15-minute charts. And a lot of people trade with a moving average cross on a 5-minute. This is even worse. I mean, there you are. You might have got a bit of movement here, and you're looking at it. And this is assuming you're catching all of this. But I bet it's not much. Where are we at? Where are we at? There's the cross. So it's underneath that. You got to that. You got 7 ticks. Wow. There's a cross there. That would have took you out straight away. So yes, you've lost quite a bit there. That's not enough to pay that off. There's a cross there. I bet that's not much either. Where are we at? There it is, under there. 3 ticks. There's another one. That would have lost. So you've got 2 hefty losers, 2 winners. You'd be lucky if you're standing still at this point. That'll only be a couple as well, whereas that one would stop you out. So what you're waiting for is this bad boy here. And you pray to God it's going to be enough to pay off them losses and leave you with a bit of profit. Common sense. However, because you're battle scarred from being ripsawed, you would probably chicken out here. And it wouldn't be enough to cover the losses. So this is what I'm talking about, using moving averages in the right environments. I use them as filters and first stage triggers. And I'll build you something up to show you an example. I prefer them as filters, and they're perfect for that, but not on small time frames. See, on a small time frame, you're bound to get ripsawed about. And because the price is bouncing around so much, so will the moving average, and it won't really give you any weighting. So if you take this out to, say, a daily, and you're using your 20, this can give you a different story altogether. If you were just using a crossover, there's a crossover there, that's a hefty move. You know, you're talking 2 or 3 ticks. You're talking 50, 60 ticks. You know, let's have a look, see what that is. So that down to there is, oh bloody hell, 322. Fantastic. But that's, well, you wouldn't have gone into it anyway because your order would be above it. There's another cross. And this is just using the price as a cross rather than another moving average. So it gets you in earlier. That's 155. But would you wait that long for a trade? Because this is daily. So you're waiting days and weeks. Probably not. But can you use it as a filter? Of course you can. And it's a very simple filter. And it doesn't matter what you use. You use 200, 50, 20. I prefer a 20 for a day trading because I want the information to be pretty much here and now relevant. If I'm swing trading, I'll maybe look at a 200 or a 50. It just depends. And this goes back to what I was saying earlier on about just clicking a couple of buttons. Got to use the right tool for the right environment. You know, moving averages are brilliant in a trend, but the market doesn't trend that much. It's normally in some form of consolidation before the burst. The burst happens and it doesn't last that long, and then it consolidates again, has a bit of a think, and then it'll either move up or move down. But what you can do is you can use it as a filter. If the price is above on a daily, you're going long. The price is below, you are going short. And actually looking at this, I can see something what somebody is going to pick up on straight away. They'll go, yeah, that's fine, but what about this bit here? It's gone long, but it immediately went short, so I'm going to get killed. Are you? Are you really? Shall we find out? Well, let's have a look. So we know on this date, what is the date? 14th, oh, 15th, my birthday, right? So on the 15th, this is selling down and crossing over. But on the morning of that trade, you would have been wanting to go long based on the date from the day before. All right. So that is my target. Okay. So the moving average is telling me to go long. So if I drop that to an hour, so I can build up a picture of what it is I'm going to trade. So I need to go back to the 14th of April. And you can back test all this sort of stuff yourself, guys. Where we are. So I want that to midnight of the 14th. Right, okay, so I'll put that over there. So the morning of the 15th, the data you would have had is this. All right, assuming you started between 7 and 9 in the morning. So what would you do? Well, the first thing I'd do is I'd mark a chart. So I can see a swing here, easily identified. Look across, it has respected there before. There's a one there. So again, box that area in. And we have a little channel through the middle of it. So kind of see that there. That's swung around. There, respect. And what you're looking at is line of sight. So there's a lump there and it's respected here. There. And this is just line of sight very quickly. All right. best fit, if you like. You can see that it's bunched up down there, so these bodies, tails don't really matter. A little bit of a bunch up above that, so we can put some kind of there, so it's like best fit, and it's kind of stalled a bit up there as well. Okay, it's a very quick markup. All right, but I'm still going long because yesterday told me I'm going long. But hindsight's a wonderful thing. We know that's sold off badly. But when you come in at 8 o'clock in the morning, you don't know that. All right? So all of this here is a bit wicked. Naughty, naughty, naughty. So what I need to do is balance out where's midnight of the 15th. It's there. So that's our trading day. And as you can see, it was quite an horrific sell-off. But as I said, at 8 o'clock here, you don't know that. You think it's going long. All right. So drop it into a trading. This is just an execution chart. Okay. Right. Now what we're doing is we're using the moving average as your bias, and we are filling in the gaps using support and resistance. This is about as basic as it gets, guys. And if you're lacking confidence in one thing and another, strip it back. Strip everything back. Forget everything that you're seeing and just go to basics. And the basics will always be support and resistance and averages. And it doesn't get any more basic than that. The moving average helps you filter. So you've seen your bias from a long time frame, the daily. You have put in your parameters on an hourly, support and resistance. Okay. And now we're going to conduct business on a 15, power of 3. I often do this, you know. I sort of mark up high, direction, entry. And it doesn't matter how you do it in one thing and another. The reason why I use 3 time frames, and I'll mix and match, and this is just giving you an idea of how to trade and how to sort of make up a chart in your own way. I have many different strategies that I use and different styles, but the fundamentals are always the same. They come from higher time frame. So this trade idea we're looking at is formed on a daily. All right. There's your moving average. So you now need some patience and some discipline, the dynamic duo. Okay. Patience is going to make you wait. So you're seeing that all the time. And the little emotion in your head is telling you to get in, but you can't because you haven't got a first stage trigger. And that's this. You're waiting for it to cross. All right. Now I'm only using a 20 here. You could use an 8. You could do whatever you want. You have to back test it, but it's just an idea. So there's your first stage trigger, which is that. And your second stage is your support and resistance. So your patience has kept you in, and you're waiting, and you're waiting, and you're waiting. Now you see in the market turn, it's closed above the moving average, and it's closed above your support and resistance. First, second trigger. You can put an order now in above there because you had a bias from the day before, and you ride it into an area that you've already pre-marked, which is here. Let's see how far it would go. You get 12 ticks. So if you go back to the compound plan that I was doing earlier on, I'm looking for 10. And I only need to do it once a day. So for all the market was selling off, you were trading against that sell-off because you had an idea from a higher time frame. You've used patience and discipline and you got paid. Now, if you do that every day, once a day, you'll be fine. But if you try and trade every single move, you'll fail. And that's what trading is. See, trading can humble you in an instant, simply because the markets will always be better than you. But that doesn't mean to say that you can't use the markets to your own advantage. And that is very simple. You see, whenever there's a big sell-off like this, people need to take profit. People are caught on the wrong side of the trade and they have to get out. So there's going to be an exhaustion point at some time during the day. And if you're looking for just the crumbs, and that's all you're looking for, guys, because picking tops and bottoms is very difficult. But those crumbs that the big boys leave behind can feed you. And that's exactly what that did. You know, and if you were scaling, like what I would put in, I'll put a few orders in, you know, how far did it actually go up? Well, when 29 ticks up. So if you did 10, 15, 20, 25 and a runner, your runner might be knocked out the game, but you did get 25 ticks. And that's using moving averages to your advantage. And I hope that kind of makes sense. What I was trying to get across with the video is to use it as a filter. And then once you've used it as a filter, just use it as part of a trigger, not the trigger, like a two-stage thing. And then you can add extra layers into it if you wish. You know, add an RSI on and see if it's overbought and like coming off an oversold condition, or a stochastic in a similar vein. You know, you might even have a MACD and see if a zero line's been breached. There's many other layers you can add to it. But what I would advise is don't add too many. You know, it's fine having an oscillator underneath, but just have one, because otherwise you'll cloud your judgment. And that's what happens with moving averages. You can have way too many on the chart and they'll just bounce between each other. But if you use a single one and understand it and get used to it, it'll feed you. Hope that kind of makes sense. I'm going to leave it there, and a little bit food for thought for you. If you've got any questions, by all means drop it in the comments below, because I genuinely answer every one. And if you genuinely stuck, my contact details are in the description. Just drop me a line and I'll do my best to point you in the right direction. So remember, guys, do what you love. The money will follow. See you all in the next one.